Welcome everybody once again. My name is Ben Frederick, President and Principal Broker of Ben Frederick Realty. My story is that my grandfather started in the real estate business in 1904. My grandfather founded his own company in 1916. My father started working in the family business in 1956. 1980, I joined the family firm. In 1986, I earned my broker's license. I also earned the CCIM designation in that year, so I've been doing this for quite a while. I also serve on the Legislative Committee of the Greater Baltimore Board of Realtors. In the past, I've served as a director on the Board of Realtors. Also on the Board and Legislative Committee of the Maryland Multi-Housing Association. It's a trade association that represents apartment owners throughout the state of Maryland. I'm past president of the Property Owners Association of Greater Baltimore, one of the oldest and largest landlord groups in Baltimore City. And I was served as president of the Maryland DC CCIM chapter. I've also taught classes in real estate in Baltimore and throughout the area and published some articles. Our team, Tom Fair, he's 10 years in the real estate business. He founded his own property management company called Fair Management. So he understands the operating side of what it takes to operate rental properties. And he's been selling apartment buildings with us for a couple of years now. Cheryl Sedera. Cheryl has been 20 years in the customer service industry. She's been with us here at Ben Frederick Realty for 6 years and we really brought her up and through transaction management, property management, and now she's working with customers, helping them buy and sell apartment buildings, which is what we do here at Ben Frederick Realty. And Will Cannon. Will, say hello.
Howdy.
Will has 30 years experience in business. Wall Street, banking, financial services is his background. Will and I started working together probably 10 years ago and getting involved in rental properties. And Will has a portfolio of rental properties that he owns and manages and got his real estate license, I think 4 years ago, and has been selling real estate for several years, again, focusing on multifamily properties, apartment buildings, and investment properties. So we'll get right into it. The 4 benefits of owning real estate. Why is owning real estate beneficial to you?
So we'll briefly discuss the stable housing costs, paying rent versus a mortgage. We'll then go on to talk about freedom and control when you're a homeowner versus a renter. The tax benefits are probably some of the most important to talk about versus renting and homeowning. And then finally, the equity and wealth, your long-term goals as a homeowner versus a renter. So the first chart is actually pretty simple. We start, if you look at day 1 or year 1, whatever you want to do down there, the bright red box would be a mortgage payment at about $1,500 a month, be it paying a mortgage or paying rent. As you can see, your rent continuously goes up. So my husband and I, when we first met back in 2010, we wanted to own, we didn't have enough money for a down payment. So we signed a 2-year lease at a really great brand new apartment complex. And we signed in, I think at $1,300 for 2 years. Our goal was to save up, get a down payment, and buy a home within those 2 years. He had a job change. I think I had to buy a new car. Life happened, didn't happen. That was a special rent discount that we signed in on. So at year 3, our rent jumped to $1,550. At year 4, I think we were at $1,620, and by year 5, we were over $17. So we rented for a little more than 5 years trying to establish the money necessary for a down payment. Finally came up with it, but it was tough. And we spent 5 years paying rent that we'll never get back. After 30 years, your mortgage is paid off and it didn't change once. So it's pretty amazing how that can happen. Freedom and control. So one of the biggest things, my dogs were laying here quietly for like during the trauma time of trying to get this up and running. Now they're behind me acting a fool, but I say no as a property manager of Ben's portfolio at least 5 times a day. When you rent, you are very explicitly told what you can and can't do. It's lined out between maybe a 2-page lease, maybe a 25-page lease. Kills me when people, they come in, maybe they have a cat, they don't have a cat. 2 months in, they call and they say, we want to rescue a dog. And it pulls at my heartstrings, but we don't allow dogs. Our insurance doesn't have it. Our insurance doesn't allow it, I should say. So, that's one big no. It hurts me. There's nothing I can do about it. Another no, maybe you just want to put a washer and dryer in your apartment. You think you've got great water pressure. You're willing to pay for it. You're willing to pay for the washer and dryer. No, negative, not going to happen. Secondly, let's say you have a drip in your sink. Your faucet's leaking a little bit. Maybe you do pay a water bill back. So you call your landlord and you say, my faucet's leaking. He sends in a shoddy contractor. He replaces the entire faucet. Now you've got a drip down below, ruining your soaps and your dishwasher tablets and eating away your wood. I mean, there are landlords that don't fix things properly for you the way that you would expect them to. There are a few good ones, few and far between. I work with 3 that you see here, but not everybody, will fix things as you would like them fixed. Additionally, when you do own, you can make improvements you enjoy. So every year, my husband adds a little bit to our garden out front and in the back. This year we made the garden a lot bigger in the back. We added some more flower beds, some more rock walls, retaining walls. It's very nice when I come home. We think about putting a pool in, and we're also thinking about converting this great room that has these 18-feet ceilings that are utterly useless and creating a 4th bedroom. So that 4th bedroom would add a lot more value to our home if we went to resell, or just as we pay our mortgage off and build our equity in the house. Lastly, there's that pride of ownership. So I rented from the time I was 19 in college. I moved back home for a couple years, but pretty much have rented for the last 15. Whenever I would have friends over or family, when we had bigger places and we could host maybe the nieces and nephews, it was always come to my apartment. It was never come to my home. There's definitely, and it's just one word, but when I say to somebody, come to my home versus, oh, why don't you come hang out in my apartment? It's different. And, family especially, they'll appreciate the little things you do. My mom notices anything right off the bat. When I go over my friends' houses, I know if they paid a painter to paint one room or the entire house, like I know what that costs, and I appreciate that with them. So there's definitely a different pride you feel when you come into your own home, and you're going to take care of it, hopefully, to keep it up and keep it gaining value. To go into the tax benefits, and this is kind of more the nitty gritty, pride's great, and who doesn't like to feel good about coming home, but look at Amazon over on Broning Highway. So Amazon gets to pay no income taxes because the government wants to incentivize them to reinvest in the company, add jobs to Baltimore City, and eventually take over more property that might be blighted, might be in really bad shape, and grow the warehouse. So we're stimulating our own local economy. Believe it or not, the government still does the same incentive offerings for home ownership. So they actually don't want you to rent forever. The government will allow you to reduce your taxable income in 2 ways. Well, actually 3, but the main 2, especially for me as a homeowner, is by being able to reduce my property taxes. Property taxes go up every year a little bit. So it's really nice to be able to deduct them. They're always going to be tax deductible. And then also my interest. So the interest that we signed on to pay, which I think we locked in at like 4.75, 3.5 years ago, we can deduct that every year. Lastly, you can reduce your taxable income by the amount you spend on repairs to rental units in your portfolio. Let's go through this kind of slowly. It looks like a lot, but it's not that hard to understand. Let's just say that you're making $65,000 right off the bat in income. So that's on paper. You're going to pay 15% in taxes. That's almost $10,000, $9,750. So that means your cash, the money you can actually spend per year, is only $55,250. So on paper, you're at 65, but if you wanted to spend your entire salary, you are almost 10,000 less than that. 10,000 is a lot of money. Let's take the same scenario, but apply those government incentives like you would if you were homeownership. So you're making 65,000, but we can deduct our property taxes at 6,000 a year, and the interest we pay on our mortgage, that's 9,000. For reporting purposes, that means that our income is only $50,000. Now take that times your tax rate at 15%, same as above. We're paying only $7,500, not $9,750 in taxes. That is yearly $2,200, 50 bucks. Break that down to a month, you're at almost $200 extra cash in your wallet. You can spend that maybe out with your friends. You can spend that reinvesting back into the home, making upgrades, changing out floors. You could spend that, or you could contribute it to your IRA. I mean, what could you do with $200 extra a month? What would you do? This graph takes a little further look at it. We're saying right now, year one, it's almost similar to the beginning where we were looking at our rent payments versus the mortgage. But we're going to say year one, we're going to buy a house for $350,000 and maybe put $10,000 down on it. So year one today, I have $10,000 of equity in the house. It is not much. However, as you pay down your interest, you pay more. Your equity rises. So if you look at this, or take my example, we put $10,000 down. We've had the house for about 3.5 years. Zillow right now says that our house is worth $332,000. I think we owe about $285 on it right now. Just math in my head, we've already got about $35,000 in equity after 3.5 years. So that $35,000, I mean, we could take that out as a line of credit. We could go on a great vacation. We could pay off a car. We could do a lot of things with that. But almost instantaneously, over 30 years, and magically, you're going to go from having $10,000 in equity right there on year one. And just by paying your monthly mortgage payment and by home value increasing every year, after 30 years, you could be a millionaire. You could have almost $1 million in equity. So it's kind of a no-brainer. Do you want to have a little shoebox full of rent receipts every year? Or after 30 years, have almost $1 million in net worth for you to do what you want, maybe pass on to your kids? It's a big opportunity.
Great. Thanks, Cheryl. Thanks for explaining the 4 benefits of owning a home. Here's an example I want to walk you through, just a specific example of what it might look like if you were to buy a property, live in one apartment, and rent out the other 2. So we're going to take a look at this house. We actually have this property listed for sale here at Ben Frederick Realty. It just came on the market a couple of days ago. It's located on 33rd Street, just a couple blocks away from the avenue. Super nice building. You can see a picture of the outside there and a picture of the first floor kitchen. So nice, attractive property, great neighborhood. Let's look at what the financials say and like how the numbers roll out on this particular property. This property is available for $470,000. We're suggesting that you would buy the property, put 3.5% down, get a 97% loan-to-value mortgage. Right now, homeowner rates on FHA mortgages are at 2.5%, fixed for 30 years. Phenomenal. So we're estimating the closing costs of $23,500 for this house, but oftentimes we can get the seller to pay most or all or make some substantial contribution towards your closing costs. So we're saying buy the property for $470,000, get a mortgage of $453,000, estimated closing costs $23,000, but get the seller to pay that. Your net investment in this property to get into this house is going to be about $16,450. Just to give you some metrics, the price per unit at $470,000, it's $156,000 per unit. $150 a square foot, so the house is reasonably priced. If we take a look at the right side here of the column here, we have the loan to value of $97,000. The mortgage amount is $453,000. 2.5% amortized over 30 years gives you a monthly principal and interest payment of $1,792.07. That mortgage will stay the same. That'll be fixed for the next 30 years. No change there. Also, part of your monthly mortgage payment, the lender is going to collect property taxes and insurance. They're going to collect that on a monthly basis. The bank is going to keep that in a savings account for you. So when the property tax bill comes due, the mortgage lender is going to pay the property taxes for you. MIP is an industry term. It's industry jargon. It stands for Mortgage Insurance Premium. Because you're putting less than 20% down on the house, the mortgage company is going to go out into the insurance market and buy insurance against your possible defaulting on this loan, and you get to pay the insurance premium on that. The mortgage insurance premium on a $453,000 FHA loan is $321 per month. As soon as you have 20% equity in the house, you can refinance or request the lender to remove mortgage insurance premium once the value of the house goes up and or the value of the loan goes down that you have 20% equity. Bottom line is that your total monthly obligation to own this house is $2,828.33. Now, how does that factor in? Can you afford $2,828.33 per month for a mortgage payment? Well, the beautiful thing is that the tenants are going to pay part of that for you. So in addition to that monthly mortgage payment, the city, Baltimore City, charges rental registration fees. They charge property inspection fees. The Maryland Department of the Environment runs the lead poisoning prevention program. They charge fees for that. As the owner of the property, you're going to pay for the utilities for the common areas. So this is going to be the heat for the building, electric for the common hallways, also pay the water and sewer bill for the property. All of those fees and expenses come up to another $406 per month. So your total monthly investment is $3,234. From that, we collect rent. So this second floor apartment is rented for $1,250 per month. The third floor apartment is rented for $1,140 per month. And there are two garages. One garage is rented for $130 per month. The other garage is rented for $135 per month. So what happens here is you're going to pay to the bank, to the bank and utility companies. Your monthly net is $3,234.83. But when you collect $2,655 from the renters in your property, your net cost is $579.83. So you're living on the first floor apartment. You can live on the first floor apartment of this building. And that first floor apartment is 900 square feet. Is that right, Cheryl?
880, sure, 9.
880 square foot apartment.
Optimistic closet.
Yep. It's got one bedroom plus a den, which could be a second bedroom. And it's got a nice front porch, a little bit of a yard in the back. You can live there for a net cost of $579.83 per month, which is less than half of what it would cost to rent that apartment. So you're signing up for $3,200 per month. You're going to collect $2,600 a month in rent. Your net cost is $579 per month. Pretty attractive. Would you agree? Now, the other thing we can look at is the tax implications of this. As Cheryl pointed out, we get to deduct mortgage interest and property taxes. So the mortgage interest, the first year interest on the mortgage is going to be $11,221. Property taxes on this building are $7,307 for total deductions of $18,000. Now, you take a 22% federal income tax bracket. This is a marginal income tax bracket at the federal level, plus 4.75% is the Maryland state income tax level. And if you add up those two taxes, you're going to save about $400 per month in federal and state income taxes as a result of owning this property, simply because you get to reduce your taxable income by the amount of mortgage interest that you pay and the amount of property taxes that you pay. So when you figure that this building is going to cost you $579 to live in that first floor apartment on a before tax basis, on a monthly basis, and then when you factor in that you're going to save $400 a month on income taxes as a result of owning this building, your net cost after taxes is only $166 per month. Who here would enjoy living in a nice 880 square foot apartment and pay only $166 per month? There you go. All right. Now let's take a look at the property value here. You buy the property for $470,000. Your mortgage is $453,000. So your beginning equity, your equity on day one is $16,450. In the first year alone, you're going to pay down the mortgage. The mortgage balance is going to go down $10,000. So the equity after the first year is going to go from $16,000 to $26,000 simply by paying the mortgage payments. If the property value goes up, your equity would be that much more. But if the property value stays the same after a year, you're going to get a 63% return on investment or a 63% increase in your equity in the property simply by virtue of paying down the mortgage. And that's the way you build wealth in America or anywhere. So next, I'd like to turn it over to Tom Fair. And Tom actually did this with his property. Tom, take it away. Explain what you did.
Yep. Thanks, Ben. Yep. Thank you, everybody, for tuning in tonight. I wanted to share with you the story of my first purchase here at 2802 Berwick Avenue in Parkville, and that's in northeastern Baltimore. So I purchased this in 2017, and I guess I'll tell you a little bit about where I was in life. I was 25 years old. I was living with roommates, and I was just starting to make enough money that I wanted to and felt like I could do something bigger and better than just pay rent. And the idea of killing two birds with one stone, that is finding a better living situation and making an investment out of it too, was very appealing to me. So in 2017, I identified 2802 Berwick Avenue as a building that I'd like to purchase. A little bit about the building. It has a 2-bedroom apartment on the second floor and another 2-bedroom apartment on the first floor. And that first floor also has access to the basement. The building was already separately metered for gas and electric, so each tenant could pay their own utilities, which is a good thing too. And we'll go over the numbers on this deal in a second. It makes financial sense, of course, but the beautiful thing is I was really excited to live there too. The second floor apartment that I was going to live in was spacious, had lots of windows and natural light. It had a nice back deck, and the property had a cool yard and a parking pad too. All right, so if you could go back one slide, Ben.
Sure.
Yeah. So these were the terms of my purchase. I made the seller an offer and we settled on $154,500 as the purchase price. Of course, I used FHA financing intended for first-time home buyers with a 3.5% down payment. And the seller paid for all my closing costs, which was great because that meant that my all-in cost to purchase this property was $5,408. At the time I purchased it, the first floor apartment was rented for $1,100. And of course, the second floor was vacant, and that was the one that I was going to move into. Okay. So when I started out, I was paying $1,400 for the mortgage, and I was collecting $1,100 in rent from the first floor tenant. And you can see the mortgage payment in the blue dot there and the rental income in the orange dot. So the difference there, I was paying about $300 a month to live there in that apartment. Now, keep in mind, for me, this looked like a pretty good deal because I had been paying about $500 a month for a single room in a house where I was before. $300 a month net payment for a whole 2-bedroom apartment was really good. I felt like I was coming out on top. And that's the same way that I operated the building for about 2 years. So we see 2 years there. And then in 2019, I refinanced. And when I refinanced, 2 great things happened. First, my interest rate dropped. And second, I nixed the mortgage insurance premium that Ben talked about from my mortgage. So my mortgage, when I refied, went from $1,400 a month down to about $1,040 a month. And you'll see now I was actually making money by living in that apartment. The rent from the first floor was still coming in at $1,100. And granted, I probably should have raised that a little bit over the years, but I didn't. And still the mortgage payment was 1040. So now I was making money. And then I moved out. And here's where things get really cool. So I moved out, and then I started collecting $1,100 from the second floor apartment. And now my mortgage payment was still $1,040, and I was collecting $2,200 a month in rent from this place. And the difference there is my net income. So that's $1,060 per month, or over $12,000 per year. So I put down $5,000, and I started making $12,000 per year from it. And that was pretty neat. Okay.
What did making an extra $12,000 do to your life? How did that change your standard of living, your sense of security?
Mhm. Well, one thing, it made me want to put more money into real estate. I'll tell you about that in a second. Even aside from the cash flow, it felt really good to be able to provide good housing for people. I had good friends from college who were living in the first floor apartment for a number of years. And even aside from them, I've been blessed with the rest of the tenants there that I've been able to find. I have a nurse and her daughter living in the first floor, and I have a retired corrections officer and his wife in the second floor, and they've all just been great. The monthly cash flow was great. I mean, who couldn't do a lot with $12,000 a year? My plan is to buy more properties with it. And really, I think one of the most powerful things that I've been able to acquire with this property is the equity that I've built up. When I did that refi in 2019, the appraised value came back at $215,000. The appraised value came back at $215,000.
And how much did you pay for it?
I paid $154,000 for it.
So you went from 150 to 215,000 in 3 years?
Yep. And my current mortgage balance is about $150,000. So that's a $65,000 difference. And that's how you can really make wealth in real estate.
So you turned $5,000 into $65,000.
Yes.
In how much time?
3 years.
3 years.
Uh-huh.
It's not bad.
Yeah. I'd like to do it again. I'd like to do it again so much that I've purchased a second building this last September, and I'm working on purchasing a third one right now for a total of 6 units.
Mm-hmm. Very good.
Yep.
Good. Excellent.
Yep.
All right. So this all sounds really good and really exciting. And I'd like to invite Will Cannon into the conversation and talk about, this sounds all well and good and exciting, but there's also an issue of doing this means becoming a landlord. And do I want to become a landlord? Am I ready for that? Will, can you chime in on that?
I will. Well, Tom, Ben, and I all own rental properties, and I started in the rental business buying properties about 12 years ago. And it is a very important question. You got to look at this stuff before you start. And so a couple issues: set boundaries. And what I mean by that is set boundaries between personal and business relationships. If you're going to live in a building and you're going to have other people in the building, you're going to get to know those people. And you have to be able to look at your rental income as a business, because it is a business. And if somebody says to you, "Oh, I can't pay the rent," or "Gee, Will, I can't find the money this month," you've got to be cold and direct and say you have to deal with them like they're a stranger. So if you have problems doing that, mixing personal and business relationships, then this may not be a thing you want to do. You're going to need to handle and hire maintenance. So either you're very handy and you can learn anything on YouTube, but you need to be able to either fix it yourself or have the ability to hire people to fix. So you will find people over time. It'll be a little bit of trial and error, but once you find people that you can trust, it can work quite well. You've got to be able to do that or have the ability, not mind picking up the phone and calling people and going through people and finding good people that work for you. The third point is here, save for emergencies. This is a very important one. This can really handicap you if you get into this business and do not put aside money every month. Your roof will go, your boiler will go. Some big expense is going to come up and bite you. And if you're not saving money every month, a small percentage, I've seen a lot of landlords, it hasn't worked out for them. They've lost their properties because they haven't saved. And so if you're not the type of guy or person, excuse me, that can save or has, if you like to spend every penny you make every month, you might be in trouble. So think about that before you get into this business. But if you can do that, you'll have that nest egg waiting for that roof. It'll work out for you. Next thing here is steps to prepare, document income. So what that means is just basically, if you're looking at purchasing, find out, document your income, whether it's W-2, whether it's you're self-employed, and be able to produce that via tax returns, via investment income. Put that together in a form that you can present to a bank, because that's who you're going to have to talk to eventually is a bank, and they're going to want that information. Everybody once a year is owed a free, per the government, you get a free credit report every year. You can go on this website, annualcreditreport.com, and get a free credit report. Very important you look at that before you start this process, or in the beginning, because if you have bad credit, you need to repair it and before you go to the bank, because they're going to say they're not going to like you very much if you come with bad credit. The way you can do that is you can correct errors, and they're in there occasionally. You can pay off small amounts, judgments that may be in there. Work on your credit. It's a very important thing to maintain a high credit rating. And if the longer you go in this business, the more important it becomes, because you're going to want to do the next property. And the next property is going to require you to have good credit. You're going to go back to the bank, and they're going to look at your credit every time. Down payment money. Have that. You're going to need, depending on the structure of your loan, whether it's FHA, 3%, whether it's more of a standard loan, a 5%, 10%, 20%. But make sure you have that money in place, liquid, so you can move forward with your investment. One other point about down payment money. If you're looking around and maybe you don't have the money, and we all sometimes don't, especially when we're young, you can do something called a gift letter. And that means talking to, your parents or your uncle or something like that, and saying, and you'll get those, and you'll say, will you lend me the money, or will you give me the money to put a down payment on this property? And your parents may say yes. If they did, they'd write something called a gift letter, and they write that directly to the lender, saying that they have agreed to give you a certain amount of money for the down payment on this house. One way you could do it. Moving on, the process. Search. As you heard Tom earlier, he referred to looking for that property, and he found a nice property in Parkville. It's important that you look in an area that you like, that you feel is it's a neighborhood that, one, you'd want to live, and two, that has decent long-term growth demographics. So, good jobs around there, or just a decent neighborhood that you think will appreciate over time. Don't always buy the cheapest thing you see, because maybe it's cheap for a reason, as far as location goes. Sign a purchase agreement. Search, again, going back to that, you can always look on our website too, benfrederickrealty.com, a great source for FHA and or investment properties. A little plug there. When you sign a purchase agreement, let's say you find the house of your dreams, you're going to have to put up earnest money. That means writing a check. You're going to hear that term a lot in the next little bit here. So be prepared. You're going to have to write a check. Home inspection. You're going to have to hire a home inspector. He's going to look at the the property, you're going to have to write a check. And that's important. You're going to see leases. They're going to produce leases for you. It's very important you go over those leases. You read the lease. I know it can be boring, but it's really important to look at the terms and make sure you're okay with them. Eventually, you may be able to change that lease, but the lease is transferred with the property, so you're gonna own that lease. Very important, the last one here, and they're all important, but look at zoning and licensing. Make sure the property is zoned appropriately for what it is. If it says it's you'll have some people saying it's a 4-unit building when it's only a 3-unit building. And trust me, I've run into this before. It is a big hassle if you don't do your homework. Even if you do your homework, you just make sure you verify with the zoning, call zoning, Baltimore City, and make sure you verify that. That's what we have there. Moving on. Applying for a loan. This is when you go to a bank and and obviously shop around different banks, different lenders, but understand that you're going to have to produce a lot of documentation. 2 years tax returns, all your investment income, W-2s, every bit of financial information, that lender's going to want to know it. So it's easier if you have that stuff ready. It's going to take you a while to get it together. Appraisal. The lender is going to order an appraisal. Once you decide on a lender, he's going to say, oh, we got to appraise the property. You're going to have to write a check. Be ready to write that check. It's, a standard appraisal can be in the, around $700 average. Obtain property insurance. It's very important that you do this. Shop around. Don't wait until the last minute. You can shop around with various insurers and find a rate that is good, and make sure you put enough liability in there. You're going to have tenants, and it's important to have enough liability insurance, depending on who you're renting to, especially. And what I mean by that is, if you're renting to college students, you might want a little more liability. That type of stuff. Maybe put an umbrella over. Anyway, too much. Title search. You need to hire a title company. What the title company is going to do is they're going to find out basically if the person who says they own the property owns the property. They will make sure that a clear title is given to you when you are done with the process, and that's very important because you want to make sure that there are no faults in the title, so they come back and bite you after closing. So that money is well spent. Very important that you register if you buy a property and you go through the process and you're closing and you now you own the property. Very important that you register with the city and the state. The city would be rental registration, and the state would be MDE, which is Maryland Department of the Environment, which is lead registration. It's important that you do that after you buy the property. You have to do it in your name. It's going to be in the other person's name. You have to re-register in your name. The lead certificates transfer, but you have to transfer it into your name. It's very important that you do that and stay up on all licensure. If somebody decides to not pay you rent and you go to rent court and the judge sees that you're not up on your licensure, you're not registered rental registration, you're not up to MDE standards, that can go against you. So you need to have that information and you need to stay up on it. That's all I have, Ben.
Very good. Thank you, Will. So just to run through and give you just a sense for like what might be out there in terms of possibilities. Right now we have 2 buildings listed for sale in Charles Village. We have 2645 Charles Street, which is 3 apartments. Right next door, the corner building is 2647 North Charles Street that has 4 apartments in it. So these are two buildings that you could buy and live in one unit and rent out the others. So that would be an option for you in the Charles Village neighborhood. Downtown, we have this building listed for sale. This is on Davis Street, which is a little, it's a small side street. It's right next to District Court Building, which is why there are two sheriff's cars in front of the building there, because the sheriffs park here and then they go over to work at the courthouse. This is a 3-story building. It could be easily adapted into 3 apartments, one on each floor. And so if you like living downtown, this would be an option for you. If you look now, the back of that sheriff's car is blocking the little driveway. There is an off-street parking space. And of course, if you live there and were parking there, the sheriffs would not be blocking your driveway. So there's an option for you downtown to own a property that has 3 units in it. 2820 St. Paul Street. It's another building in Charles Village, 3 apartments. The first floor has a particularly large, apartment on the first floor. It's got a nice yard in the back. You can see in this picture, it's got a nice yard in the front, nice porch front. This would be a property that would be ideal for owner occupancy. 3510 Greenmount Avenue. This house backs up to, this house is in Guilford. It is technically in the Guilford neighborhood, even though it's located on Greenmount Avenue. So your backyard is, all the Guilford amenities are all right there. This building is set up as 3 apartments. You got a nice front porch. There's also a garage in the back, a big 2-car garage in the back. It is an end of group building, so it's got a nice side yard. And this would be a property that would be well suited for owner occupancy. So this just kind of gives you an overview. We've talked about what the cash flow is like, of what it could be like for you if you owned a building, bought a property, lived in one apartment and rented out the other 2 or 3. We talked about the tax benefits of owning an income producing property. We talked about how you can oftentimes own these properties, live on the first floor and pay less in mortgage payments than you would pay in rent. And what a huge benefit is that? As well as we just demonstrated how you could become a millionaire in 30 years. When your mortgage is paid off, the value of the property goes up, you could be a millionaire. So it's not so difficult to do. Are you willing to take the next step? So we would like to encourage you to visit our website, which is benfrederick.com. There's also a sign-up page. You can sign up to be on our mailing list. The first thing we do when we get new listings is we send email to our customers. And that's the way to find out about the newest, latest, greatest properties that come on the market. And we'd be willing to share that information with you. Our team is here. Will, Tom, and Cheryl are here to help you and work with you, show you properties and help you guide you through the process. Will's phone number is 410-916-3331. You can reach Will at will@benfrederick.com. Tom can be reached at 410-235-5200. His email address is tom@benfrederick.com. And Cheryl can be reached at 410-235-9500. And her email address, of course, is cheryl@benfrederick.com.
And Ben, before we go, we have a couple of questions in the chat box that came up.
Yes,
Do you think we
please.
could address these?
Fire away.
Okay. Terrell asks if the tax considerations that we went over would apply for LLC ownership of a building or an individual or a family.
Well, we gave the examples that we walked through were in the context of a homeowner buying a building, living in the first floor apartment, renting out the other apartments is the way that we structured that. If you are going to get a 30-year fixed rate homeowner loan at the low homeowner rates, and if you remember, the interest rate that we quoted on an FHA mortgage today is 2.5%. That's the homeowner rate. The rate on an investor loan is going to be in the 4% range. So you can't get a 30-year fixed rate loan if the property is titled in the name of an LLC. So that is one important consideration about whether to title a property in an LLC or take it title in your name individually. And be happy to talk to people about their individual circumstances on an individual basis.
Yep. Let me see here. Yep, we have another question about should you create an LLC or holding company to manage your properties?
Again, we advise for homeowners, if you're going to be living in the building and renting out the other units, it's probably advisable to keep title to the property in your name individually. If it's in your name individually, you can get a discount on the rental registration fees as an owner occupant. You can get better financing on the mortgage if it's in your names individually. You can later transfer a property. At any time, you can transfer a property's title from your name individually into an LLC that you wholly own. There's no transfer tax to do that. So maybe at the point where you own a couple of properties or you're getting a little bit larger, or if you move out of the property and turn it into a straight rental property, might be a time to transfer title from your name individually into an LLC.
Mm-hmm. Yep. We have another question here. Do you work with hard money lenders compared to traditional lenders to acquire properties? And the answer there is that, yes, we do have a lot of hard money lenders. Oftentimes the rates are going to be closer to like 10 to 15%, and they're really intended for like as bridge loans. Or in other words, to stabilize a property that might need renovation or repair. And
Short term.
Short term, yes, short term, and then
Hard
the
money loans are good for
refinance,
short
yes,
term, yes.
right.
Yeah.
So as a first-time buyer, I typically encourage you to, seriously consider what it would be like to have a loan like that, and maybe direct you to an FHA or a conventional mortgage for the first one. Another question here, from Ben. For financing purposes, does a 4-unit apartment with ground floor retail classify as a 4-unit or a 5-unit?
So residential financing is defined as a 1 to 4 unit building, residential only. So if a building has a retail or a store or office on the first floor and 1 or more apartments on the upper floors, that property is considered a commercial mixed-use property. So you can only get 30-year fixed-rate residential financing on buildings up to 4 units where all 4 units are residential in use.
Right. And to piggyback on this, Ben, even properties that have all residential units but have C1 zoning or any kind of commercial zoning in Baltimore City, even if they're built out as just residential apartments, I've been having a really tough time getting FHA lenders to wrap their head around that. And so to me, it's best if you're using FHA financing to go with a straight residential multifamily without any kind of possible hangups there.
Mm-hmm.
Right. Ben, I see your second question here, and I'm going to probably give you a call to answer that one. We're going to move on to Taisha's question. The tax benefits that we talked about, are those for the first year, or does that carry on to all the years afterwards?
It carries on to all of the years afterwards. So we gave an example where we took the first year's interest payments. Of course, the interest payments are going to change every year. Property taxes are going to potentially change every year. So those figures will change every year, but the concept is the same. Every year, for as long as you own that property, you'll get to deduct your mortgage interest, and you'll get the benefit of that mortgage, of that tax deduction. You'll be able to deduct your property taxes, and you'll get that benefit of that tax deduction all the years that you own that property. And you'll be able to take that deduction whether it's your personal residence or whether it's a rental property.
Okay. Taisha also asked, how often do we get new listings?
Every week.
Uh-huh.
Every week. The inventory is constantly changing. So really, you can check the website anytime you like. You check it weekly. If you go on the website and sign up to be on our email mailing list, again, that's where the first thing we do when we get a new listings is send an email to our clients, to our customers, And so that's the best way to keep up to date on the new properties coming on the market. That email list, by the way, just to give people some comfort, I hope, is that the only thing we do with that, when you sign up for our mailing list, the only thing you're going to get are property listings. We do notify you of legislative updates that affect rental property owners, and that's it. So you'll get emails about legislation that affects rental property owners, and you'll get emails about new listings, and that's it. We don't sell the list to anybody. Nobody else has access to that list. It's purely used for that purpose only.
Okay. Karif asks, how much would he need to put down for a conventional loan for a multifamily property? Would it be a 5, 10, or 20% down payment?
If you're going to live in one of the apartments and rent out the others, you can get residential owner-occupied financing. Minimum down payment on a conventional loan is 5%. You're going to pay mortgage insurance premium. You can put down 10% and you'll pay mortgage insurance premium. If you put down 20%, there's no mortgage insurance premium. So that's on an owner-occupied multifamily building up to 4 apartments. Anything, now if you're buying the property as an investor, the investor requirement is 25% down. So you have to put 25% down if you already own a home and you're living in your home and you're buying a multifamily building as an investment property, you'll be putting 25% down.
Yep. To answer your question, yes, Ben Frederick Realty brokers buildings in the greater Baltimore area in Maryland. And I think that's all the questions that we have here. Oh, yes, a recording of the presentation will be available on the website to those who have asked.
Yep. We will have that posted. We have a YouTube channel for Ben Frederick Realty. We have a YouTube channel where we have all of our videos on there. We have videos about property management, how to manage properties, how to rent apartments. We have videos on how to appeal your property tax assessments. We have videos on managing properties, investing in real estate, all kinds of good stuff there on our website at benfrederick.com, as well as on our YouTube channel for Ben Frederick Realty. So check all that out. All right, so thank you for your time, everybody. Thanks for joining and sharing in our evening here. And good luck in your real estate investing. We're here to help you any way we can.